All right, welcome everyone. Today we're going to answer one of the most important but overlooked questions in personal finance. How much life insurance do you really need? So whether you're a parent, a spouse, or someone just trying to protect your financial future, this conversation is about making sure the people you care about are taken care of no matter what, without overpaying or missing critical coverage. Let's get to the next slide here. So before we dive in, here's a quick but very important disclosure. So this video is for educational purposes only. It is not legal, tax, or financial advice. Everyone's situation is unique, and I strongly encourage you to talk with a licensed financial professional to get personalized guidance. Products and regulations can vary by state and change over time, so don't make decisions based solely on this presentation. So, why does the right amount of coverage matter? If you have too little, your family might struggle to cover basic needs like housing, education, or income replacement. On the flip side, too much coverage can mean you're overpaying premiums that could have been invested elsewhere. So, it's all about striking the right balance based on your actual life situation goals. So there are three main methods we use to estimate how much life insurance you should consider. Each has pros and cons, of course, and you might use more than one depending on your situation. So we'll start with the simplest. There's the income multiplier, then the dime method, and finally the most comprehensive, which is a full needs analysis. So the income multiplier method, it's quick and easy. You simply multiply your annual income by some factor, right? Usually between 5 to 15, okay? For example, if you make $75,000 a year and you use a 10x multiplier, you'd be looking at $750,000 in coverage. So the idea here is to provide your family with enough replacement income over a certain number of years, right? That multiplier is the years, so 5 years, 10 years, 15 years of your potentially lost income. So how do you decide whether to use 5 or 15? Well, rule of thumb, if you're younger, if you have kids, or are the primary breadwinner, you'll likely lean more towards the higher end. If you're older, closer to retirement, or your family has other assets that can be liquidated if desired, then you might use a smaller multiplier. Again, it's just a rule of thumb, not a final answer. Now, the dime method, okay? This method digs a little bit deeper. It stands for debt, income, mortgage, and education. So you estimate the cost for each of these and you add them up to get your total insurance need. This method is more personal and detailed than the income multiplier, and it's a great next step for more accurate planning. All right, so let's break down each part of the dime method, right? So D, it's going to be your debt and final expenses. So these are things like credit cards, personal loans, funeral costs, student loans, right? Auto loans, that sort of stuff, okay? Debt. Um, I, income replacement. How many years would your family need support for not really if, but when you pass away, okay? Mortgage. What's left on your home loan? Education expenses, the future cost for your kids' college or private school. So adding these gives you a much clearer picture of your actual needs. So here's an example. Let's say you have $40,000 in debt and final expenses. Um, you want to replace $80,000 of income for 15 years. You owe $250,000 in your mortgage, okay? And you may want or need $150,000 each for two children for college. So if you add all that up, okay, and you're looking at around $1.79 million in coverage. All right, this makes it more real. These aren't just random numbers, they're your actual family's future. Now, the needs analysis method is the most comprehensive. So you start with something like the dime method, but you also factor in your savings, investments, and existing insurance as well. So you're not just going to be stacking numbers, you're actually calculating the gap between what your family would need and what they already have. So it does take more time, but it gives you the most accurate picture. So here's a quick example. Suppose your dime-based need is 1.79 million, just like from earlier, but you already have $200,000 in savings and other funds here. Okay, $100,000 savings and investments, 50,000 emergency funds, right, and then 50,000 college funds. Right, and then you probably have a $150,000 term life policy when you were younger. All right, so in this case, if you take all that, subtract it from 1.79 million, your gap is $1.44 million in additional coverage needed, right? So in general, that's what you'd want your personal life insurance to cover. It's more efficient and it also avoids overinsuring. Okay. Alternatively, okay, you can maybe just say you want to cover these other assets as well, right? So, just add another $200,000. So that's $1.64 million yeah, in coverage gap needed. All right, so life isn't a one size fits all, right? We all know that. If you're a stay-at-home parent, your value isn't measured in income, but in services like childcare, home management, and support. If you're single with no dependents, then your focus might just be debt and funeral costs, right? Maybe you don't want to, you don't want to burden your parents with that stuff, right? If you're funding college, that adds a whole new layer. Okay, your coverage should reflect your real life, not just your paycheck. Life does change constantly, as we all know, so should your insurance. Marriage, divorce, kids, buying a home, paying off debt, changing careers. So all of these things can either increase or decrease your insurance needs. It's always smart to revisit your coverage at least, every 3 to 5 years, right? If not annually, okay, or whenever you hit a major milestone. So here's something most people don't realize. Your need for coverage usually does go down over time, okay? I mean, really, it just depends on your again your situation and your goals and your perspective, right? But in general, it does go down over time. As your kids grow up, debts get paid off, and you build your savings, you're less financially vulnerable. So don't feel like you need to buy a massive policy forever, right? Unless you want to. Okay, we can talk about that later, but your insurance plan should evolve with you. So to recap, we've got the income multiplier method. It's quick, but it's not personal, right? Dime method, it's more tailored, but it's still pretty simple. And then, of course, your formal needs analysis. It is going to be the most accurate, but it does require more time and data. Okay, there isn't really a best method. It's just one that makes more sense for you. It just depends on how complex your situation is, okay, or how complex you want it to be, if anything. But some clients do start simple and then they just build on it over time. Okay. And typically that's kind of what you want, right? The more complicated things are sometimes, and you want to build over time. You want to grow and become bigger and have more. So a few tips to wrap up. Review your policy every few years. Okay, maybe every year. All right, it's not going to be a set it and forget it type of tool. Think about your family's unique situation, not just general advice. Make sure you're comfortable with the premium. Okay, you don't want to be just over leveraging yourself. All right, you want something that's going to be sustainable. If you're not sure where to start, talk to a licensed advisor, right, who can give you unbiased guidance. All right. To wrap it up, life insurance is not about fear. It's about love and responsibility. It's about creating peace of mind that your family's dreams and future aren't left to chance. Whether you're just getting started or need a second opinion, the right coverage is one of the most important and powerful tools in your financial plan. All right, thanks for watching. If you found this valuable, make sure you hit that subscribe button and the like button and follow for more financial education. And if you have questions or you want a personalized review, if you want to walk through your own insurance needs or just ask a few questions, I'd be honored to help you figure out the next best step for your goals. All right, leave a comment and you can also reach out to me. I'd be happy to help.